Ever look at all these investment options out there and thought, well, what's even all this? Stocks, bonds, ETF, mutual funds, cryptos. It's like an endless buffet of confusion. But don't worry though, because you're definitely not the only one feeling that way. So in today's video, we're keeping it super simple. We're diving into something called minimalist investing. And to be more specific, a super clean strategy called the 3-fund portfolio. It's basically the go-to setup for anyone who wants to invest smart without turning it into a full-time job. So by the end of this video, you'll learn what the 3-fund portfolio is all about, why it's so effective even for beginners, and how you can set it up yourself without any stress. And just to put this out there right now, guys, this is not financial advice, but just my own financial opinion on how to do things. Now let's get into it. What is the 3-fund portfolio? So all right, first thing first, what the heck is the 3-fund portfolio? Well, as the name implies, it's a portfolio that uses just 3 funds. Specifically, these 3 are usually a US stock index fund, which cover the US stock market, an international stock index fund, which cover market outside of the US, and a bond fund, often a broad US market fund. And that's about it. 3 fund, and you might be thinking to yourself, really? Only 3? Well, yes. Instead of holding 20 different investments or trying to pick the next hot stock, with 3-fund portfolio, you keep it super simple. Each of these funds is likely a basket containing hundreds or even thousands of individual investments. For example, a total market stock index fund can include over 3,600 stocks in just one fund. So with just 3 funds, you could own a slice of almost every stock in the market worldwide. It's like getting an entire menu instead of picking just 1 or 2 dishes. So in a nutshell, the 3-fund portfolio is a diverse mix of US stock fund, an international stock fund, and a bond fund. It's ridiculously that straightforward. You're not trying to time the market, you're not trying to stock pick, and you definitely don't need any complex strategies. Just 3 broad funds that together cover a huge part of the global market. Why the 3-fund portfolio work? Now you might be wondering, if it's so simple, why does it work? Shouldn't I be doing something more complicated to get better result? Well, not necessarily. The 3-fund portfolio is popular for a few really good reasons. Number 1, diversification. Don't put all your eggs in one basket. Even though it's only 3 funds, each fund is super diverse. The US stock funds give you ownership in thousands of American companies, from tech giant to retail stores. The international funds spread you across Europe, Asia, emerging markets, etc. And the bond fund adds stability with government and corporate bonds. So with these 3 together, you're not betting on any single company or even a single country. You're basically betting on the global economy as a whole. This broad mix helps reduce risk. For example, if one stock or even an entire sector had a bad year, it's not going to destroy your entire portfolio because it's just a small part of your big basket of investment. Number 2, low cost. A huge advantage of the 3-fund approach is that it's built with index funds, which are known for having very low fees. You're not paying some super manager to trade stock for you. Instead, the fund just track the market. Many total market funds have expense ratios under 0.1%, which is just a few dollars a year on a $1,000 investment. Some even charge near 0. And this is important because every dollar you don't pay in fees is a dollar that stays invested and growing for you. Over decades, low fees can translate into thousands of extra dollars in your account. Plus, the track record of index funds is really good. In fact, studies have shown that roughly 80% of actively managed mutual funds, the one with the high price managers, end up underperforming the simple index fund they're trying to beat. Now think about that. The odds are not in their favor. So by keeping costs low and just riding the market, you're likely doing better than most fancy strategies out there. Number 3, simplicity and ease of use. This is the minimalist part. With only 3 funds, your investment life becomes super easy to manage. There's a famous saying in investing, investing should be like watching paint dry. In other words, boring is good. And the 3-fund portfolio embodies that. You won't be constantly checking your portfolio or chasing the latest meme stock because your strategy doesn't require frequent changes. It's basically set it and forget it. Once you choose your fund and set up your contribution, you can go live your life. And yeah, you'll pick at your portfolio occasionally because of curiosity. And sure, it's good to rebalance once in a while, which we'll cover later, but you won't be stressed every day. This simplicity can actually make you a better investor because you're less likely to make emotional decisions. And lastly, solid performance over time. By owning broad market fund, you're effectively saying, I'll take the market return. And historically, the market has been pretty kind to patient investors. For example, the US stock market, as measured by something like the S&P 500, has returned around 10% per year on average over many decades. While three-fund portfolio won't beat the market since it is the market, if that makes sense, it will capture those returns if you stick with it. And capturing the market return consistently is an excellent outcome for long-term goals like retirement. So remember this, it's not a race, it's a marathon. And slow and steady wins. How to build a three-fund portfolio step by step. Setting up a three-fund portfolio is straightforward. You don't need a finance degree or tons of money to get started. Here's a simple step-by-step guide, right? First, choose your asset allocation. This is just a fancy way of saying decide what percentage of your money goes into stock versus bonds. It's a personal decision and it depends on your goal and risk tolerance. A common guideline is the 100 minus your age rule for stocks. For example, if you're 30 years old, 100 minus 30 is 70. So you might aim for about 70% of your portfolio into stocks and consequently 30% in bonds. If you're 50, maybe you go with 50-50, 50% in stocks and 50% in bonds. This isn't a hard rule, but it's a starting point. Younger investors often lean more heavily into stock for growth since they have time to ride the ups and downs. Older investors might include more bonds for stabilities. Within your stock portion, you'll also decide how to split between US and international stocks. Some people do a 50-50 split between US and international stocks. Others might do 60-40 or even 70-30 in favor of the US stock. It's pretty much up to you. The key is to pick an allocation that you can stick with comfortably through thick and thin. So number 2, pick your fund. Now that you know your allocation, you need to select the actual fund to invest in. If you're using a major brokerage or retirement account, look for a total US stock market index fund for your US stock portion, a total international stock index fund for your international stock portion, and a total bond market fund for the bond. These could be mutual fund or ETF, exchange traded fund. For example, at Vanguard, a popular trio is the Vanguard Total Market Index. It covers essentially the entire US market, Vanguard Total International Stock Index, and Vanguard Total Bond Market. Other companies like Fidelity, Schwab have similar fund. Fidelity has the FZROX for US stock, for instance, and they even have zero fees fund. The exact fund name doesn't really matter, to be honest, as much as making sure that each one is broad-based and low cost. If you're unsure, you can literally search for a total stock market index fund with your brokerage name next to it, and you'll pretty much find it. Sometimes 401k plans might not have these exact funds, but they usually have equivalent like the S&P 500 fund, which cover a large chunk of the US market, plus maybe an international fund. So just pick the closest option you have, and remember, there's no need to overthink it. Broad coverage and low fee are the two main criteria. And number 3, automate and chill. Now that you have everything figured out, it's time to put the plan into action. Decide how much money you want to invest and how often. For example, I'll invest $500 of the first of every month. Then automate it if possible. Most brokerage let you set up automatic investment or transfers so the money will go into your 3 fund without you having to even do it manually each time. Automation is awesome because it removes the raw power from the equation. You won't be as tempted to skip investing during a shopping spree or even if the market is scary. It's just happening in the background. After that, your job is mainly just chilling. Checking your portfolio maybe a few times a year, but when you do, see if your percentages are still close to your plan. Over time, some part will grow faster than others. If stock has a big run, your 70% stock might become 75% just because they grew. When things get out of hand, you do a rebalancing. Basically, sell a little of what goes up and buy a little of what goes down just to get back to your target. For many, rebalancing once a year is enough. And if that sounds complicated, you can even set some account to auto rebalance or just adjust contribution, like temporarily direct new money into an underrated fund. But honestly, with only 3 funds, rebalancing shouldn't be that hard. It might just take you 10 minutes on a Sunday afternoon, give or take. Why this strategy is minimalist and awesome. So you probably noticed the word minimalist in the title. We call this a minimalist investing strategy because of its simplicity. Think of minimalist lifestyle, you declutter, keep only things that add values, and ignore the rest. The 3 fund portfolio is exactly that, applied to investing. It goes with the idea that less is more. By trimming your portfolio down to the essentials, you eliminate the noise. No more going through a dozens of funds or stock. No more second guessing whether you should start fund A for fund B. With only 3 funds, you know exactly what you own and why you own it. This can be incredibly freeing. It's one less area of life where you have to manage complexity. It also reduces decision fatigue. Every extra investing you hold is another decision to make. When to buy, when to sell, is it doing well, etc. With a minimalist approach, you make a few big decisions up front, like your allocation and fund choices, and then you really have to make decisions again. Fewer decisions equal fewer opportunities to mess up or stress out. This is especially helpful for beginners. It keeps you from the trap of constantly messing with your investment, which frankly often does more harm than good. And it's also worth mentioning that simpler portfolios are easier to stick with during tough times. When the market goes crazy, and trust me, it will at times, a complicated portfolio can tend you to do complicated emotional reactions. With a 3-fund portfolio, on the other hand, it's clear you own basically everything in a balanced way. So if the market drops, you know you still own the same solid pieces you owned yesterday. The entire US economy, the global economy, and a bunch of stable bonds. That perspective can make it easier during hard times. So thank you guys for watching today's video. If you gain any value from this, don't forget to like, subscribe, and push the notification bell for more on sustainable fashion, personal finance, and minimalism. I'll see you guys on my next video.